Let's jump right into this explainer. We're zeroing in on Agilent Technologies today. It's a massive, $33 billion life sciences giant. They're the folks building the complex analytical tools that labs rely on all over the world. But right now, well, they find themselves right in the middle of one of the most perplexing mysteries on Wall Street.
I mean, think about this billion-dollar question for a second. How does a highly profitable company manage to grow its revenue, literally grow its net income, and yet simultaneously watch 28% of its stock value just vanish? It's wild. Usually, when the bottom line swells, the stock price follows suit. But Agilent? They're basically defying gravity in the exact wrong direction.
Just look at the extreme tension here. On one side of the ring, you've got this relentless bearish momentum. The stock has plunged over 28% from its 52-week high of around $160. But then on the other side, bullish fundamentals. Wall Street analysts are aggressively defending this thing. They've got a consensus strong buy rating with a price target pointing right back up to those recent highs. So someone is completely wrong here.
To actually solve this disconnect, we need to completely tune out the market noise and go straight to the receipts. By cracking open Agilent's official Q2 2026 SEC Form 10-Q, we can look past the hype, get to the raw numbers, and see exactly what is happening under the hood.
All right, Section 1, Q2 Financial Snapshot, Exploring the Receipts.
Starting at the top line, honestly, the story is incredibly strong. Net revenue jumped to $1.835 billion for the quarter. That's up from $1.668 billion just a year ago. And this growth, it was fueled by really broad-based demand for their life sciences tools, essentially the specialized lab equipment and software that scientists literally cannot do their jobs without. Put simply, people are absolutely buying what Agilent is selling. But here's the thing. Revenue is only half the story. You have to look at their profitability. Net income saw a massive year-over-year leap, jumping from $215 million up to a staggering $339 million. So they aren't just selling more stuff, their margins are actually expanding, which allows them to keep significantly more cash from every single sale.
And that leads us straight to a rock-solid balance sheet. As of April 30th, Agilent is sitting on a massive war chest. We're talking over $1.8 billion in cash and equivalents. Now sure, they carry about $3 billion in long-term debt, but when you're generating $277 million in operating cash flow in a single quarter, debt service really isn't a concern. This business is a cash-generating machine.
Moving right along to Section 2, Rewarding the Shareholders, Following the Capital.
So you might be wondering, what is management actually doing with this massive influx of cash? Well, they're directly rewarding investors. This past quarter, Agilent paid out exactly $72 million in cash dividends. That breaks down to just over 25 cents per common share. They are actively taking that cold, hard cash and putting it right back into their shareholders' pockets. But listen, those dividends? That's really just the warm-up. This SEC filing brilliantly illustrates management's ultimate confidence in their own business. We're talking about an active, board-authorized share repurchase program of up to $2 billion. $2 billion! When leadership authorizes a buyback of that scale, it's like planting a flag in the ground and saying, look, our own stock is literally the absolute best investment we can make right now.
And it's not just big talk. They are actually executing on this. In this quarter alone, they went out and spent $65 million scooping up 550,000 of their own shares. I mean, that is a clear, undeniable signal that the folks running the company believe their stock is an absolute bargain at these levels.
All right, Section 3, Bearish Chart, Bullish Analysts, the Market Disconnect.
Okay, so despite the undeniable financial strength we literally just walked through, the stock chart tells a grim, completely different story. After hitting that high of $160 in November 2025, it started this steady, painful slide. By February, it broke below its 200-day moving average. Now, if you know charts, you know that's a critical technical indicator that signals deep, long-term bearish momentum to traders. Today, it's down nearly 16% for the year, drastically underperforming the broader market.
But get this, fundamental financial analysts are stubbornly ignoring that broken chart. 17 different analysts covering Agilent have maintained a strong buy consensus, and they're suggesting a massive 42.5% premium. They're looking at the exact same pristine balance sheet we just reviewed and concluding that, hey, this sell-off is completely irrational.
To wrap up our explainer today, we are basically looking at a classic Wall Street standoff.
You have phenomenal business fundamentals that are completely decoupled from negative market momentum. Think about it. Revenues are up, net income spiked, cash reserves are absolutely huge, and management is literally buying back stock. Yet despite all of that, the price has plummeted 28% from its highs, and technically, it looks completely broken.
Which leaves us with this final thought for you to take away. In the battle between a flawless balance sheet and a broken stock chart, who is usually right? Is the market severely mispricing Agilent right now, offering this incredible margin of safety for value investors? Or is this a classic value trap, masking some hidden, forward-looking risk that these pristine historical financials just aren't showing us yet? That's the real puzzle you have to solve. Thanks so much for joining me today, and keep learning.